inflation is very high, in part too high.
Consumers still have a lot of liquidity.
I think that 2022 may be the year that the pandemic enters an endemic phase.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. More turmoil at Credit Suisse. The embattled bank asked its chairman for breaking COVID rules after just 9 months in the job. Growth risks mount. China cuts rates. The world's second biggest economy takes repeated hits from COVID outbreaks. And Bill Ackman says the Fed should raise rates by 50 basis points in March. The billionaire investor thinks the central bank is losing its battle against inflation. Now, first thing is first, let's check in on the markets. A little bit of a mixed picture in terms of what we're seeing in the U.S. and Europe. Remember, it is Martin Luther King Day, so Treasuries closed as a lot of U.S. stock markets. So it'll be something to watch out for tomorrow. But certainly, we're seeing a bit of a repricing because of what's happened in Treasuries on Friday. European stocks gaining some 0.4%. Again, it's trying to understand whether we will see a bit of supported level because of PBOC being much more accommodative. But then China is on a different path to the rest of the world. So how do you play that differential, if I can say the word differential? That will, of course, have a huge impact on commodities across the world. Basic resources, you can see getting some 1.2%. And then our main corporate story is, of course, Credit Suisse. We'll get onto that. Our second corporate story is a sale of a part of GlaxoSmithKline to Unilever. And you can see Unilever down some 6.6%, Glaxo gaining on the back of it. Now, there is also difference whether you're sitting in the UK looking at the FTSE or whether you're looking at the FTSE MIB over in Milan. The picture here in the UK is also one of political turmoil, although the party gates that Boris Johnson is needing to face as we await, of course, a civil servant, Sue Gray, to come out with her findings, is not having an impact so far on sterling and therefore not on equities. The CAC 40 gaining 0.5%. So the banker tasked with fixing Credit Suisse has been ousted just 9 months into the job. The chairman, Horta-Osorio, resigned after an investigation into him breaching COVID quarantine rules. It throws the Swiss financial giant into fresh turmoil as it undergoes a strategic overhaul after losing more than $5 billion from the twin collapses of Greensill Capital and Archegos Capital Management. Well, joining us now to discuss all of this is Filippo Aloatti. He's head of financials at Hermes Fund Management. Filippo, thank you so much for joining us. Does it mean that actually we could see a kind of UBS Credit Suisse combination? These kind of rumors keep on coming up. How does it change the strategy going forward?
Yes, good morning. Well, no, actually, I think it's a bit of more of the same in the sense that this episode about Horta-Osorio is a bit of a sad coda to already, as you said, a not very edifying story in 2021 and previously with the scandal of spying on its employee. I think it's also was inevitable because the bank, correctly, in my opinion, trying to remain out of the headline and rebuild the culture and also the fame in risk management. So I think it's more a Credit Suisse than in the next 2 years. So we'll focus on building up the capital buffer, fixing the risk management. And so the incoming chair has a very extensive experience in management. So I think this will be helpful for them.
But Filippo, what was behind this? So does breaking quarantine rules, and I don't want to put into context what's happening in the UK, where a prime minister has definitely on numerous occasions probably broken some rules and it's still in charge. Is it different because it's Switzerland, or is it different because it's just a private bank?
No, I think it's different because it's Credit Suisse, considering what Credit Suisse has been going through over the last 2-3 years. And I think culture and rebuilding the reputation of the bank was one of the key words also in the strategic update. So I think it's almost mathematical that, of course, I mean, unfortunately, the chair slipped on these 2 occasions. So I think he did the right things to resign. I think also the board did the right things to accept this resignation. I think also they're lucky to have a relatively safe pair of hands in Axel Lehmann on the board, although he's only joined from a year ago from UBS, but he has extensive experience in Switzerland. He was at Zurich. He was chief risk officer of UBS, so he does have quite some experience.
So, Filippo, overall, what kind of banks do you like the most? I know you're looking at the credit of the banks, where will probably be helped by the ECB and a normalization in interest rates. But does it matter if you're a UK bank, a Swiss bank, or a European bank on how you perform?
Yeah, I think so. It does matter. And I think, for example, Credit Suisse, it's a good story because I think the next couple of years will be really focused on the credit as opposed on shareholders. They were good in raising capital the height of the storm. And I think so there will be a little less shareholder remuneration. I think so shareholder remuneration is the key word for 2022. And I think we'll see more European banks, even in the Eurozone, going the American way, disbursing more to shareholders. I think it's natural given the part we are in the cycle, but I think also that needs to be put with a certain context. And I think also DCB with the past Gardner, I think is a good supervisor. It is the Bank of England, and also in America with the new appointees to the Federal Reserve. So I think more shareholder remuneration, but up to a certain limit, not to impoverish the creditworthiness of all those banks and insurance companies.
So, Filippo, I know we have a number also of earnings in the US. They're more expensive than Europe, but is that where you find the most value?
I think it's in the portfolio we run, so we have a combination between the American banks, which are relatively fuddy-duddy. I mean, so better profitability, better exposure to a potential steepening of the yield curve, because of course, so the Fed will act in March and will act throughout the years. Versus in Europe, I think so the market is only penciling in a rate hikes in 2023, unless of course ECB change in the second half of this year the guidance. And also in the UK is a little bit in between because we'll have higher rates. The market is expecting 1% refinancing rate by the end of the year, which I think in the grand scheme of things is not extraordinary for the P&L of the banks, but still is a little help. And I think also this year will be about credit normalization. All those banks, they're giving away this reserve they built during COVID as the economy recovers and the industrial activity picks up pace.
Yeah, Filippo, overall, what happens to a lot of European banks? Are we going to see a bit of M&A because we're still overbanked, or are we still waiting for authorities to say yes or no to it?
Yes, I think also we'll see more M&A, and I think also there's some news in Italy, and I expect some more of this type of domestic M&A in markets such as Italy, Germany, potential France and Spain, because also they remain, as you said, overbanked. And so there are far too many banks. And actually, if you're just a bank, you don't make a lot of money, where given the rates are negative at the short part of the curve, and the curve still remain relatively flat versus, for example, America. So I think, yes, it's a part of the toolbox of the bank's management to manage down the expense. And so they have some quite experienced, because of course, so negative rates, it's been there for quite some time, but I think M&A is just part of the toolbox, and expecting more of it in this year.
Filippo, thanks so much. Filippo Aloatti, their head of financials at Hermes Fund Managers, joining us this morning. Now, let's also take a look at some of the stories we're following this week. Today, Euro area finance ministers meet in Brussels to discuss a post-pandemic recovery. Tomorrow, the Bank of Japan is set to hold its first monetary policy meeting of the year. Officials have already said they're nowhere near to normalizing policy. And December's inflation figures for the UK are due out on Wednesday, with economists forecasting a CPI print of 5.2%. Then on Thursday, we're expecting Turkey's rate decision. We expect the central bank to keep monetary policy unchanged. And finally, on Friday, it's UK retail data. The rapid spread of Omicron and the government's decision to introduce tighter restrictions could hit consumers. Coming up, growth risks mount. Will China cut its key interest rate as Omicron outbreaks hurt an already slowing economy? More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China's central bank cut its key interest rate for the first time in almost 2 years. That's as economic growth slowed last quarter as consumer spending actually took a dive. Well, let's bring in Bloomberg's China economy editor, James Maker. James, great to speak to you again. The economy actually grew faster than expected, but it was at 4%. Is that what we're going to have to get used to?
the government, has made clear that they want economic stability this year. That, they said the Communist Party economic officials said that they, stability was their watchword for the, for the economy in 2022. So I think 4% is a little low. They seem, the indications we are getting is that 5% or more is what they're looking for. So that's partly why the reason why the PBOC cut rates today is to try and increase that or improve that growth, so that they can create the number of jobs they want and see the economy grow stably this year.
So what's driving growth right now, and actually what is holding back the economy apart from the zero COVID policy?
The housing market, I think, is the biggest thing that's the biggest drag on growth right now. You saw real estate investment slumped, through 2021. You saw infrastructure investment also falling, even though the government was, the central government was continually telling the provinces they needed to borrow and spend quickly through last year. That really didn't happen because, on the one hand, they're being told to spend. On the other hand, local governments also being told to cut down on debt and to cut down, especially on bad debt. So you saw a double whammy both from the housing market, but also from infrastructure investment and project investment, which really didn't happen. And those are the two things that really hit, that hit spending growth. Then obviously also there is the zero COVID policy, where the government's, it's not the COVID so much as the restrictions the government puts in place to stop the spread of COVID, that is really affecting really affecting retail sales.
All right, James, thank you so much. James Magyar, there, our Bloomberg China economy editor. Now we're joined by Hugh Gimber. He's global market strategist at JP Morgan Asset Management. Hugh, great to speak to you. On China, we now have a PBOC that's actually a lot more dovish, which goes against everything else in the rest of the world. Talk to us about what that means for investment opportunities.
That's right. Good morning, Francine. So you're absolutely spot on. I think this is no different to the challenge that's been facing investors really for much of the past 2 years, which is that China has found itself in a very different phase of its recovery to the rest of the world. So last year was all a story about China tightening at a time where developed market policy was still easing. Now we're facing the flip side, where I think you can expect further easing to come through from Chinese policymakers over the course of 2022, at a time where clearly a lot of focus has been spent on understanding the tightening that's ahead from the developed market central banks. Yeah. So when you add that to the more attractive valuations in China now, I think you could start to see some investors being tempted back in.
So does the China policy actually change your outlook for inflation globally?
Not really, because I think what you're seeing from China is policy which is designed to stabilize the economy. This is not China really upgrading their growth targets for this year. This is rather policymakers doing enough to ensure that that level around 5%, perhaps slightly higher, is going to be achieved.
So where do you see the best value? If you look at, the next 11 months, and we're now hearing a lot more calls for Fed to actually normalize with a bigger interest rate increase instead of the timeline, does it change where you want to be invested in?
So at the moment, I'd still prefer developed markets over the emerging markets. And that's because I think investors will need to get further signs of confidence that you're going to see a rebound, not just in the Chinese economy, but also in other parts of Asia. And to understand that the markets that had such a torrid time with the Delta variant and the lockdowns there are going to be able to handle Omicron better. So at the moment, still favoring developed markets. I think within DM, you're really focusing on the cyclical sectors, the banks, the energy, the industrial parts of the market. But I do think that further out in the year, there are going to be decent opportunities to come within EM.
Yeah, and Hugh, I know we've been, waiting for the Treasury market to reprice for as long as I can remember, but is this the year?
I think there's further room for Treasury yields to rise this year. When you look at the pricing in that market now, really the pricing over the next 1 year to me looks reasonable. You've got markets pretty much assuming that 4 hikes are on the table for 2022, which I would agree with. Where I would disagree with market pricing is further out. It's about the terminal rate for the Fed, which still looks too low for me. I think markets will need to see the hikes coming through this year to understand that the US economy can simply handle higher rates, and that actually there's further room for the terminal rate to rise, which is what I would expect to drag Treasury yields, particularly at the longer end of the curve, higher through the course of this year.
All right, Hugh, thank you so much. Hugh Gimber there from JP Morgan Asset Management stays with us, and we'll talk a lot more about repricing in treasuries. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Here in the UK, Boris Johnson is reported to be considering staff changes and a series of policy announcements in the wake of a crisis over pandemic rule-breaking parties at Downing Street. The Times newspaper says the UK Prime Minister is planning populist announcements, including tackling the backlog of operations in the health service and removing remaining COVID-19 restrictions happening later this month. Now, Novak Djokovic has been deported from Australia after a federal court upheld a decision to revoke his visa. Djokovic had hoped to compete for a record 21st Grand Slam title and a potential $2.1 million payday at the Australian Open, which of course starts today. The Australian government said Djokovic risked boosting anti-vaccine views. In a statement, Djokovic said he respected the court's ruling and now plans to get rest and also to recuperate. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, I feel like I know a lot more about Djokovic, even things that I didn't really care to know, or even things that I didn't care to know about the way that the Australian system goes for a visa. I mean, it's really been dominating a lot of the headlines when we should have been putting the spotlight on other things.
Well, Francine, it's been like a tennis match, hasn't it? Back and forth when it comes to the Novak Djokovic saga. And we are also seeing the Australian Open now underway. And in case you're watching it today, and I don't want to spoil it for you, British #1 Cameron Norrie has crashed out in the very first round. But once again, this shows that the government was really determined to uphold its policies on vaccines in Australia, and it sets precedents for other upcoming sports events in the country, Francine.
It does. It really puts it in the spotlight. Leanne, as always, thank you. Coming up, a shock 50 basis point hike. Well, billionaire investor Bill Ackman says the Fed needs to take a dramatic step to restore credibility. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, global bond markets are under pressure. Treasuries selling off on Friday on increased speculation of a March rate hike by the Fed. Billionaire hedge fund manager Bill Ackman says the FOMC needs to raise rates by 50 basis points in March to restore credibility. Well, Hugh Gimber from JP Morgan Asset Management is still with us. Hugh, what kind of interest rate rise are you expecting? And do you assume that actually the timeline could change? Or is it actually also by which amount they increase by?
So personally, I think it's more likely that they're going to use the timeline. I think they'll be looking to stick to a 25 basis point increment wherever possible. Because let's bear in mind, it was only a couple of months ago that the Fed's narrative was all around being patient and being determined that if they're going to make a policy mistake, it's because they move too slowly rather than too quickly. So I personally think it's quite unlikely that we'd see 50 basis points in March. I think they'll set the tone that 25 basis points in March is the first of several hikes this year, but we'll be looking to ease into this hiking cycle more gradually.
Hugh, what exactly is being priced in at the moment?
Yeah, so we have close to 4 hikes on the table for 2022, which I think is quite reasonable now. The big unknown is more around the balance sheet. I think that will be the discussion for the second half of the year. Personally, I'm in the camp that around June, July, they're probably going to be ready to start running off the size of the balance sheet. But that, I think, is where there's more scope for markets to be surprised. Because it could well be that actually when the Fed start this hiking cycle, they think a lot more carefully about how they balance rate hikes versus the balance sheet to achieve the shape of the curve. I think they're going to be combining those two to try and get the curve steeper if they can.
Hugh, we spent most of 2021 with the market saying, to the Fed, really watch out for inflation, and the Fed really until the third quarter saying that, inflation was temporary, that we'd have to look through it. Have central banks lost credibility because of it?
No, I don't think they have. What has changed, though, is the pressure that they're under from the labour market. The labour market has been tightening more quickly than most expected, particularly the central banks expected through the fourth quarter of last year. And that's what's putting them under real pressure. because it was easy for them to look at the big spikes in goods prices that we had coming from the supply chain problems last summer and to say, we don't need to worry about this. This is a transitory issue. But now when they start to see wage growth picking up, it's true in the US, it's true in the UK as well, that I think is why they've really come into this year feeling quite strongly like they're behind the curve.
So what does it mean for dollar? Does it go even lower from here, or does it stabilize out?
I think it probably stabilizes, because clearly for FX markets, what matters most is what's going to be priced in. And as I say, I think now you have the bulk of the Fed's hiking already priced into markets at the front end. So for me, stable dollar from here is a decent base case for the rest of the year.
Well, great. Thanks so much, Hugh Gimber there, global market strategist at JP Morgan Asset Management. Now, coming up, Credit Suisse ousts its chairman for breaking COVID rules after just 9 months in the job. We have that story up next. If you look at the share price, of course, for Credit Suisse, down some 1.5%. Also, it's Blue Monday, so we need a bit of cheery stories. I don't know whether the focus needs to be on treasuries or some of the repricing there, but we have all of your market moves shortly. This is Bloomberg. More turmoil at Credit Suisse. The embattled bank ousts its chairman for breaking COVID rules after just 9 months in the job. Growth risks amount. China cuts rates. The world's second biggest economy takes repeated hits from COVID outbreaks. And Boris Johnson faces another bruising week. The so-called Partygate scandal puts his future as prime minister in the balance. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So first thing is first, let's check in on the markets. Of course, a reminder, it is Martin Luther King Day in the U.S., which means a lot of the U.S. markets are closed. We're expecting thinner volumes than usual. Treasuries will not open. Here in Europe, the focus on equities gaining some 0.5%. That has to do with what the Fed can and cannot do. I'm looking at media, minor, and healthcare leading the advance. And of course, a dollar gauge, little change. Oil ticking up, U.S. stock again, and bond markets shut today for a holiday. Now, the advance of the Omicron virus and also corporate earnings are coloring sentiment, and really investors are now looking for signs that corporate profits can help arrest this retreat in global equities, led in part by a slide in U.S. technology shares. Now, the banker tasked with fixing Credit Suisse has been ousted just 9 months into the job. Chairman Horta-Osorio resigned after an investigation into him breaching COVID quarantine rules. It throws the Swiss financial giant into fresh turmoil after the Greensill and Archegos scandals, which cost the lender $5 billion. Well, joining us to discuss all of this is Bloomberg's European finance editor, Jeff Black. So, Jeff, I know very few people are expecting the resignation. I know you were expecting it. Does it only have to do with breaking COVID rules, or were parts of the bank also not convinced he was the right man for the job?
Good morning, Francine. I wouldn't claim to have expected it at midnight on Monday, but that's what happened in the end. It went maybe quicker than most people had expected it. Look, before all of this, with the quarantine breaks happened, there were plenty of question marks at Credit Suisse about Horta-Osorio. The strategy revamp that was announced in November was a mixed bag, if you're being charitable. He hadn't managed to repair the bank's stock price after the two debacles in 2021. And we already know that they were going to have to announce another loss for the fourth quarter. So it was going to be a pretty difficult pitch for Horta-Osorio going forward anyway. And then if you add in the current environment that he basically thought he could act with impunity and fly around Europe with disregarding quarantine rules, then, it becomes clear that that's very, very difficult to survive in the current atmosphere.
So, Jeff, what does it mean for the bank going forward?
Well, we now have a new chairman in the shape of Axel Lehmann, who is, on his CV at least, he's the consummate Swiss insider. He's been 20 years at Zurich Insurance, at UBS. He's got fairly limited international experience, in fact. So this looks like a more traditional style of chairman who's going to work with Thomas Gottstein, the CEO, to implement the strategy review that they already announced in November, buckle down and hope that they can get through.
Thank you so much, Jeff Black there with the very latest on what happened at Credit Suisse. Now, let's get on to Russia and geopolitics, warning that time is running out to secure a deal that guarantees NATO will never admit Ukraine, something the alliance actually rejects. Now, speaking at the end of a week of diplomatic meetings, the Russian Foreign Minister Sergei Lavrov said Moscow won't wait endlessly for an agreement.
We will not wait forever, and their plans to drag their heels over this are in place. We are aware that the prospects of reaching a consensus depends on the U.S.
Meanwhile, a Ukrainian probe has concluded that all evidence points to Russia having been behind a cyber attack last week that disabled several government websites.
We need to work through attribution. This is part of the Russian playbook, so it would not surprise me one bit if it ends up being attributed to Russia. And yes, of course, if it turns out that Russia is pummeling Ukraine with cyber attacks, and if that continues over the period ahead, we will work with our allies on the appropriate response.
Now, for more on all of this, we go to our European correspondent, Maria Tadeo, live on the ground in Brussels. So, Maria, the mood ever more somber. The diplomatic efforts continue. What can you tell us?
Yeah, it is, Francine. And today we have the German Foreign Minister Annalena Baerbock making a trip to Ukraine. Tomorrow she will be in Russia, in Moscow, meeting with Lavrov. The German Foreign Office has put out a statement suggesting that Germany does want to have a thorough and stable relation with Russia, but the list of conflicting issues is growing and will take measures if the situation escalates. But Francine, we've heard this many times. Germany is saying we will take action if Ukraine is invaded or threatened, but we know that Germany has been very hesitant to take perhaps some of the tougher measures that the U.S. has been pushing for, particularly when it comes to sanctions and in particular when it comes to Nord Stream. They have been very reluctant in getting the Nord Stream into potential sanctions just yet. We also know that this pipeline is waiting for certification, but nonetheless continues to be a problem, especially we're seeing big tensions already within the coalition.
Maria, prices again jumping on gas and electricity. What can leaders do about it?
Well, and today, Francine, European finance ministers are meeting here. By the way, it's also Christian Lindner that's making his debut. It's not just about foreign policy here in Brussels today. We know this is a concern for inflation. It is for corporates. We know what it did to EDF on Friday, and we know what it does to households. The issue here is how to solve it. There isn't a plan on the table. Some countries suggest they have to buy in bulk. Others believe that this is about renewable and investing in that transition quicker. The other issue, Francine, that's equally thorny is, of course, the taxonomy. The nuclear versus energy that is putting already the Germans and the French at odds, and that makes a joint procurement even more difficult.
Yeah. All right, Maria, thanks so much. Bloomberg's Maria Tadeo there in Brussels, where, of course, the Eurogroup will start today. Now, European stocks advancing as traders weigh a global rally in bond yields and the start of earnings season. Let's bring in Bloomberg's markets live editor, Eddie van der Veldtz. Eddie, I'm excited to speak to you. I know bond markets are closed in the U.S., as are equities, but actually it's an exciting day, or certainly an exciting week. We both saw implied and realized volatility in stocks pick up a little bit at the start of the year, but how much of that is fear over higher rates and how much is actually just positioning?
Francine, absolutely. You know, you mentioned volume earlier on, and actually in European stocks today, we're seeing volume doing quite well, a little bit above the 30-day average. Of course, part of that period was the Christmas period when there's naturally a lull. But you know, I think it is absolutely not a boring day in markets. It almost never is these days. And you know, I think yes, we are seeing some positioning just for the start of the year. I think 2022 is shaping up to be the year of active management. What we're seeing very divergent opportunities. Whether you look at various stock markets, whether you look at the bond markets, where you know some central banks may raise quicker than others, or whether you are looking at commodities with a very different outlook for something like copper than, for instance, for something like oil. And I think there's a real split within markets, and I think people are still struggling to pick their winning horses for the beginning of the year. And I think that's part of the reason why we had all of this volatility so far.
Eddie, that's a very good point. Also, Brent crude trading near levels last seen since 2014. Is this shaping up to be another bullish year for commodities?
I have to say, you know, I backed the wrong horse in commodities last year. I thought copper was going to outperform, but Brent did fantastically well, and it did so on the back of an OPEC that really supported prices. Now this year, you've got to wonder whether OPEC still has the firepower to do so again. And shale production is picking up in the oil market. So the upside feels a little bit capped for crude, notwithstanding the current prices that we're at. I think we could be trading around these levels for the rest of the year. But again, commodity is something where I would like to pick, specific horses rather than buying the basket.
Eddie, what do you do with gold? Pretty disappointing here, despite the inflationary pressures. Do you just pile into Bitcoin?
Shocking. Absolutely shocking year last year, right? If you told anybody gold inflation was going to come in at 7%, what would you buy? A lot of people would have said, put my money behind gold. And gold did nothing last year. It did worse than nothing. It was down 10% in real terms. Now, I think you're going to struggle to see gold do better this year because real rates are starting to pick up. But really, if you look back at 2012, 2013, it was a similar story then. Gold picked its peak significantly before real rates picked their bottom. And I think that's what we're seeing this time around. I think there are a lot of echoes from last time when we saw quantitative tightening for the first time and this time around. And I think that's what the gold market is telling us at the moment.
Eddie, what do you do with Bitcoin today?
Yeah, Bitcoin is a tough one to call, isn't it? I mean, people are talking about it as the rival for gold, but the correlations just aren't there yet. I think Bitcoin, I think people will continue to play Bitcoin as a risk-on asset for the time being, correlating with tech stocks and so on, high beta play, small allocation in the portfolio. I think that's still how people will look at it this year.
Eddie, thank you so much. Eddie van de Vout there from our MLive team. Now, coming up, beauty companies were some of the biggest losers during the pandemic, but Makiage is capitalizing on the opportunity to revolutionize makeup through AI. We talked to the Chief Financial Officer, Lindsay Druckerman. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Makiage is a beauty brand using data science and machine learning to try to deliver an in-store makeup experience online. The company has recently raised $130 million in a funding round that values it at $1.5 billion. Now the challenge is to continue disrupting the beauty industry through growth opportunities. Well, we're delighted to be joined by the Chief Financial Officer of Makiage, Lindsey Druckerman. She's also the former head of consumer equity capital markets at Goldman Sachs before moving to Makiage in 2014. So, Lindsay, thank you so much for joining us. And I know also waking up very early for us. I mean, this is a different beauty brand because you use AI to basically match foundation colors and other colors online. Does the pandemic help with that because people were stuck at home? Or do you, did you see actually demand for your products decline overall?
Yeah, thanks so much for having me. Look, we are a digital direct-to-consumer beauty and wellness platform with a mission to transform the global beauty and wellness market through technology, enabling products and incredible services in a way that the consumer has never experienced before. Makiage is the first brand that we launched off of our platform. It's the fastest growing beauty brand in the United States. We've had incredible traction pre-pandemic, during pandemic, post-pandemic, across all our markets, including international. We've got the UK, Germany, Australia, really every market that we've launched into, we've seen incredible success. The business has doubled every year since inception 3 years ago. We're doing over 260 million of revenue. And I think very distinct from what you've seen, I know you talk to a lot of online businesses. We've done this all with incredible profitability, really from an early stage. And that's that big driver of that profitability is our differentiated technology approach.
And Lindsay, yeah, so first of all, I have to correct myself because I think you joined the business in 2021 and not 2014. So apologies for that. But what's your biggest challenge going forward? So at the moment, you're going from strength to strength. As a company, grows, there are more challenges. What do you worry about the most?
Yeah, I mean, look, the market opportunity for us is enormous. And so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market. our secret sauce has really been our direct dialogue with our consumer, asking users what they want, and harnessing that rich data, funneling it through our technology infrastructure, as you mentioned, data science and AI, in order to deliver formulation.
We have you back, Lindsay. We just had a couple of connection problems, but yeah, continue. You're talking to us about, some of your strengths, but also some of your challenges.
Yeah. So look, for us, what's truly been our special sauce is the direct dialogue that we have with our user, and asking them very specific questions, learning from them, and then funneling that rich data through our data science, our machine learning, to deliver them the exact right product. And it's something that's entirely different from the legacy model of beauty companies and wellness companies that are wholesale models, right? They sell to retailers. Yep. The retailer gets the information. The retailer has all the insights. That model worked very well in a largely physical, largely offline world. But as the market shifts to 50% online or more, those data insights are critical, and we're the absolute best company to be successful in that backdrop. And so for us,
Lindsay,
sure, go ahead.
Yeah, no, I was going to ask you actually what the end game was, whether, a lot of beautiful companies that have grown significantly in beauty then get bought out by Estée Lauder or L'Oréal's of these worlds. Is it something that you think will happen to Makiage, or is the idea of remaining independent?
Our opportunity set ahead is incredible. We're very excited. We think we've built a technology backbone that can support multiple billion-dollar-plus portfolio of brands. Makiage was the first brand launched off of our platform. Our second brand launch is coming imminently. And all of the users that we've amassed, are more than 25 million users, are more than 1 billion data points, give us a tremendous edge and insight on how the consumer is looking for new brands and new products to satisfy their needs in the global beauty and wellness market. And it's full of so many offline brands, legacy brands, so many pain points for the users, and things that our technology can actually solve those pain points. And so we're excited about those multiple brand launches for the future. It's very bright.
So, Lindsay, we're looking at a McKinsey report saying that in 2021, Gen Z and millennials, the most tech-savvy consumers, still bought 70% of their makeup in a physical store. Are you expecting that to change?
I mean, it's a great insight, Francine, because part of why we took this amazing technology we had and approached the global beauty and wellness market is because it lags in online adoption relative to other product categories. And that's quite puzzling, considering all those Gen Z and millennials and other consumers spend so much time online, whether it's on YouTube or Insta, getting their education, getting their inspiration, only to end up in a physical store to transact. And the challenge for them is that, beauty and wellness categories are different than many other categories. You can't just buy a product your friend recommends. You can't just search in an online catalog. You need very specific, tailored product recommendations. And that was requiring consumers to go into a store. That knowledge gap was requiring that physical trip, with a lot of friction for the consumer. Our machine learning, our data science solves that issue. And so we are unlocking that online distribution. So no, I don't think in the future you're going to see the majority of purchases happening in store, because our technology enables it for the first time to happen at your convenience wherever you are.
Lindsay, I feel like I've been in store so many times, and even with the person-to-person contact, my foundation color was wrong. So I don't know whether this is a good or a bad thing for AI. How much more do you want to grow in other countries outside the West? Are you targeting China, or are there other parts of the world that actually could significantly grow in?
Look, our business today is about 25% international. As I mentioned, the markets that we've launched in, we've had incredible success really in every single market we've launched in. If you look at an Estée or L'Oréal, their businesses are 65, 70% international. We believe that we can significantly expand our international presence. We have lots of launches in new markets planned for the next couple years, and we're really excited about what the future holds. But let me tell you something about the color of your foundation. It is different if you're in store under studio lights or you go outside. And our computer vision technology, which nobody else has anything close, in hyperspectral recovery, which actually can see through your smartphone all wavelengths of color and recover that, turning everyone's smartphone into a hyperspectral instrument. And so we actually believe that through that application of computer vision and hyperspectral recovery, we can tell you, Francine, what exactly foundation color you're wearing and what the perfect match is for you.
Okay, challenge accepted. Lindsey Druckerman, their Chief Financial Officer of Makiage, joining us this morning. Now, coming up, could Partygate topple Boris Johnson? We discuss how the scandal of breaking COVID rules is engulfing the Prime Minister and threatening the stability of the Tory party. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, here in the UK, the Prime Minister Boris Johnson faces another bruising week as a furious backlash over rule-breaking parties inside Downing Street continues to rumble on. Let's get more with Bloomberg's UK political editor, Kitty Donaldson. Kitty, good morning. So Tory MPs have been in their constituencies over the weekend. What are they returning to in Westminster?
Good morning, Francine. Well, what they're returning to is a febrile atmosphere. They've been at home all weekend, talking to their agents, talking to the people in the street, in their local areas, and they come back and now they've got a chance to compare notes and talk to each other and see where they're up to. And the answer is probably not very good for the Prime Minister. If you've gone home and you've absorbed all that anger, you're going to take it out on someone when you come back to London. That doesn't necessarily mean that he's in immediate danger. Tory MPs need to submit 54 letters of no confidence for there to be a leadership contest or a leadership vote or vote in Prime Minister's leadership. And we're nowhere near that yet. We're only up to about 7 or 8, maybe 10 people who have submitted letters. So unless someone from the cabinet resigns, which seems unlikely, Boris Johnson's safe for now. Having said that, quite a lot of people are waiting and holding on for the Sue Gray report, which is due either this week or next, and they're waiting to see what she says.
So, Kitty, does the Prime Minister stay? I know there's about, 30 people that signed letters, but they need 54 to actually have a vote of no confidence. So does it all depend on what Sue Gray comes out with? Like, what's the next thing to happen?
Yes, absolutely. And everyone's waiting on Sue Gray. They think that she'll present a report. It might just be a statement of facts. It might just be this is what happened. This party happened here. This party happened then. And then she might recommend some disciplinary measures for people in Downing Street. Yep. And for some people might go, might resign, might be sacked. But in terms of Boris Johnson himself, I don't think much is going to change in the next couple of weeks. Don't forget, most of the cabinet owe their jobs to him. And also, there isn't a natural successor, at least not yet.
Kitty, thank you so much. Our UK political editor, Kitty Donaldson. Well, Bloomberg Markets continues the next hour with Danny Berger here in London. This is Bloomberg.